None of the Fed officials who've been hinting at an interest rate rise this summer would ever be as definitive as to say, and you can take that to the bank. But investors have taken it to the bank, or bank shares. Thanks to the Fed's jawboning, US bank stocks have hit their highest levels so far this year. Since the start of May, financials have outperformed every sector except IT, and the largest banking sector ETF, whose assets were previously down at a 3-year low, that's also perked up suddenly. Only 2 other ETFs have attracted more money in the past week. Expectations for future rate increases continue to be a major driver of bank shares. Higher rates mean that banks are going to be able to expand the margin between where they borrow and where they lend money to their customers, and that will finally help them counter the relentless squeeze on profits that regulators have been applying since the crisis. Such has been the gloom around the sector, in fact, that many large banks had been trading below their estimated book value, suggesting they might as well shut up shop. This week, however, JP Morgan Chase, it moved back into positive territory relative to book value for the first time since January's recession scare. Now, the latest boost to bank stocks that's come in recent days, you can see from this chart what's the reason for that. There's a realization suddenly that a June rate rise is on the cards. And that in turn has led more people to bet that the Fed might even match its official forecast of 2 rate hikes before the end of the year. The market's pricing in a 25% probability of that happening, compared to less than 10% just a fortnight ago. The rising oil price has been another tailwind for the banking sector, just as declining oil prices contributed to the sell-off earlier in the year. Investors were worried that balance sheets might be stuffed with loans to loss-making energy companies. A $50 per barrel oil price is going to assuage some of those concerns. But there's always something to worry about in the banking sector. The rating agency S&P warned earlier this week that rising commercial real estate lending could increase risks at many regional banks. Undervalued financial stocks then have finally caught a bid, but this is not a sector with much excitement around it yet. It's not in danger of overheating, and you can take that to the bank.